Hey everyone, welcome to our deep dive on investing. We're tackling some really interesting ideas from the book, From Zero to Millionaire.
Yeah, it's a great book.
And what's really cool is the author, they learned all these lessons kind of the hard way, making a bunch of mistakes before figuring things out. So they're sharing their wisdom to help us avoid those same pitfalls. So let's jump right in. The book starts with this story about the author having lunch with a friend in San Francisco. Like yoga mats, fair trade coffee, the whole vibe.
Yeah.
And right in the middle of this totally chill scene, the friend drops this bomb. They're convinced that the United States is like on the verge of collapse.
Oh, wow.
Talk about a mood killer, right?
Yeah, the author points out this isn't just some random thing.
Right.
They've noticed that it's often like really successful, educated guys who think their gut feelings are like the key to predicting the market.
Interesting. So are you saying that our instincts are totally useless when it comes to investing?
Well, not completely useless, but definitely not the most reliable way to go about it.
Okay.
Like think about the South Sea bubble.
Oh, yeah.
Back in the 18th century, everyone, even brilliant minds like Isaac Newton, thought the South Sea Company was, a sure thing. They poured all their money into it.
Right.
Only to see it crash and burn.
And wasn't there something called tulip mania, too?
Exactly. In the 17th century, the Netherlands went crazy for tulips. People were trading their houses, everything they owned, just for a single tulip bulb.
Wow, crazy. But how do those historical examples apply to us today?
Well, the interesting thing is that human behavior hasn't really changed that much. Even now, in the 21st century, we're still susceptible to those same emotional biases that fueled those bubbles back then. Fear, greed, the promise of getting rich quick. It can all cloud our judgment.
Yeah, for sure. So even with all the technology and information we have, our emotions can still trip us up. Okay, so if gut feelings aren't the answer, what actually makes someone a successful investor? Is it all about complex algorithms and insider information?
That's a great question. And the book addresses that head on.
Oh.
The author actually argues that investing at its core is really pretty simple.
Right.
It's just that the financial industry benefits from making it seem way more complicated.
Yeah, that make it complicated strategy. I see that everywhere.
Right. But here's the empowering part. The book emphasizes that everyone already has the superpowers to be a good investor.
Superpowers. Okay, tell me more about these superpowers.
Well, think about it this way. You have the power to build financial freedom and security for yourself, to be generous, to create a safety net for the future.
Right.
Those are some pretty serious superpowers, and they come with smart investing. You don't have to be like a math genius or have secret information.
I think a lot of people get intimidated by investing because it seems like this exclusive club.
Right.
But you're saying it's not like that at all.
Exactly. One of the big takeaways from this book is that anyone can become a successful investor if they have the right knowledge and mindset. The book even discusses how real estate fits into the picture, which is something a lot of people can relate to.
Yeah, and the author also makes a great point about the power of compounding.
Yeah.
Like starting early.
Yeah.
They use this example of parents investing just $1 a day for their kid.
Right.
It seems like nothing, but over time, it can snowball into something significant.
It's like that snowball effect.
Exactly.
Time is your biggest advantage when it comes to investing.
Okay, that makes sense. But I think a lot of people are still hesitant because they've heard those horror stories about people losing big in the stock market.
Yeah.
Like the author actually talks about their own experience during the dot-com bubble, riding high, dreaming of early retirement, and then bam, the crash wiped out all their gains. A lot of us are afraid of losing everything.
It's a valid fear.
Right. Yeah.
The dot-com bubble is a perfect example of how speculation and short-term thinking can backfire.
So how can we protect ourselves from those big market swings?
Well, it starts with understanding that the market has its ups and downs. They're totally normal.
Okay.
The key is to have a long-term perspective. Don't panic when things get a little shaky.
Easier said than done, though, right?
Right.
But the author also brings up this interesting point about professional investors. They mentioned this report called SPVA, which shows that most pros don't even consistently beat the market over the long term.
It's shocking how many underperforming funds there are across different categories. It really challenges this idea that paying big fees guarantees better returns.
It's funny, the author tells this story about a dentist who got so obsessed with trading that he was neglecting his patients. It just shows how easy it is to get caught up in the hype.
Absolutely.
Okay, so we've talked about gut feelings, market cycles, ignoring the noise. But what about building a balanced portfolio? Remember that story about the author meeting with an insurance salesman when they were only 20?
Oh, yeah, that was a funny one.
Yeah. Who wants to talk about retirement planning when you're barely old enough to buy a beer?
Exactly. But that story introduces a really important concept.
Right.
The difference between stocks and bonds.
Okay, so can you give us like a quick breakdown of what those are? Why are they both important for a balanced portfolio?
Sure. So stocks are like little pieces of ownership in a company.
Mm.
They have the potential for higher returns,
Right.
but they also come with greater risk. Bonds, on the other hand, are more like loans that you make to a government or a company.
Okay.
They generally offer lower returns, but are considered less risky than stocks.
So it's kind of a trade-off, risk versus potential reward.
Exactly. And that's why diversification is so important. By having a mix of stocks and bonds in your portfolio, you can smooth out those bumps in the market and reduce volatility.
So it's like having shock absorbers on your car.
Exactly.
Okay. So how do bonds specifically help with that volatility?
Well, they don't react as dramatically to market swings as stocks do. Think of it this way. If the stock market is like a dog on a leash,
Okay.
and the overall economy is the owner, the dog might be zigzagging all over the place, but the owner is still walking in a relatively straight line.
So the dog, the market, is jumping around, but the owner, the economy, is more steady.
Exactly. And that's why bonds, which are more tied to the overall economy, provide that stability when the market gets wild. Also, looking at history, the stock market has always gone up in the long run, even with all the crashes.
Wow, that is reassuring.
It is.
Okay. But I think a lot of us struggle with, like, getting sucked into that daily news cycle
Yeah.
with all the doom and gloom about the market. You know those headlines? Market plunges, investors panic.
Absolutely. That's where the book's advice about turning off news notifications comes in.
Okay, but why is all that financial news so bad for us? Shouldn't we stay informed?
Being informed is one thing,
Right.
but being bombarded with negativity is another. Think about it. You wouldn't stand in front of the Mona Lisa crammed with a crowd just to get a quick glimpse, right?
Well, I admit I've done that, but I
Yeah.
get your point.
The point is that constantly checking market updates and reading those headlines can actually hurt your investment strategy. It triggers fear, anxiety,
Right.
and leads to impulsive decisions you might regret later.
So true.
Remember that Josh Brown quote, "News apps are designed to suck you in."
Yeah, they are like slot machines keeping you hooked.
And it's not just negativity. Even positive news can be misleading. There are tons of examples of experts making predictions that turned out to be totally wrong.
So are you saying we should just ignore the news completely?
Not necessarily. Staying informed about major economic trends and events is good, but you have to filter out the noise. Focus on your long-term goals. Remember, successful investors like Warren Buffett ignore that daily chatter and stick to the fundamentals. He started investing during World War II.
Yeah, that was a crazy time to be investing.
Exactly. It shows that staying invested, even in tough times, is crucial. Trying to time the market perfectly is like chasing a mirage. Even the best can't do it consistently.
Okay, so we've talked about gut feelings, market cycles, ignoring the noise. But there's another silent killer that a lot of investors don't realize is lurking. Fees.
You got it. Fees are like this hidden tax that eats away at your returns.
The author makes a great comparison. It's like getting ripped off by a taxi driver on a deserted island.
Oh, yeah.
You're stranded, you need a ride, and they demand a ridiculous fare because they know you have no other choice.
Perfect analogy. We often feel powerless when it comes to fees, but we actually have more control than we think.
So what are some of the common fees that we should be watching out for?
Well, there are management fees, expense ratios, trading commissions,
Oh, yeah.
all sorts of hidden charges that can really add up.
Okay, so what's the best way to minimize those fees? It can all feel pretty overwhelming, especially when you're first starting out.
The first step is simply knowing what you're paying
Okay,
and then choosing investment options that are low cost.
so with all this in mind, how do we go about choosing the right investment strategy for us?
Well, the book outlines 3 main approaches. DIY, using a discount brokerage, the hands-off approach with robo-advisors,
Okay.
and then seeking personalized guidance from a financial professional.
Okay, let's start with DIY. What exactly is a discount brokerage? What are the advantages?
It's basically an online platform where you can buy and sell investments directly without going through a traditional broker.
Gotcha.
The biggest benefit is you have full control over your portfolio and usually pay much lower fees.
So it's like cutting out the middleman.
Exactly. This is a great option for people who are comfortable doing their research and managing their investments themselves. You also get access to a wide range of investments, including low-cost ETFs.
Okay, and what are ETFs?
ETFs are exchange-traded funds.
Okay.
They're like baskets of stocks or bonds that track a particular index or sector.
Right.
They're an awesome way to build a diversified portfolio.
So what are some specific examples of low-cost ETFs that people could look into?
Well, for broad global stock exposure, the Vanguard Total World Stock Index Fund ETF, ticker symbol VT, is a great choice.
Okay.
If you want to focus on U.S. stocks, the Vanguard S&P 500 ETF VOO is popular.
Gotcha.
For bonds, the Vanguard Short-Term Bond ETF BSV is a solid pick. And for those seeking growth, the Vanguard Growth ETF portfolio, VGRO, could be a good fit.
Wow, so many options. I can see how it could be overwhelming.
It definitely can be. That's why it's important to do your research and choose ETFs that match your own risk tolerance and investment goals. But the good news is that there are a ton of online resources to help you learn and make informed decisions, even if you're not a finance expert.
That's good to hear. What about rebalancing? I hear that term a lot.
Rebalancing basically means adjusting your portfolio to maintain your desired asset allocation.
Okay.
For example, if you start with a 60% stocks and 40% bonds portfolio, over time, your stocks might grow faster than your bonds, throwing off that balance. Rebalancing involves selling some stocks and buying more bonds to get back to that 60-40 split.
So it's like pruning a garden.
That's a good way to think about it. And it's something you can easily do yourself with a DIY approach.
Okay. But are there any downsides to this DIY approach?
Well, as the author points out, there are no barriers to bad behavior when you're managing your own investments.
Right.
It's easy to get emotional and make impulsive decisions, especially when the market is volatile. You also need to be comfortable with the mechanics of buying and selling ETFs and managing your account.
That's a good point. So what about robo-advisors? How do those work?
Robo-advisors are like automated investment platforms. They use algorithms to manage your portfolio for you.
Interesting.
You answer some questions about your goals, your risk tolerance, and your time frame.
Right.
And the robo-advisor creates a diversified portfolio of ETFs based on your answers.
So it's like having a digital financial advisor.
Exactly. One of the biggest benefits is it takes the emotion out of investing. The robo-advisor automatically rebalances your portfolio and makes adjustments so you don't have to worry about timing the market or making rash trades.
Sounds pretty hands-off. What are some downsides?
Well, you have less control over your investments compared to DIY.
Right.
You can't choose specific ETFs or easily adjust your portfolio on your own. The level of personalization also varies between platforms. But overall, robo-advisors are a great option for people who want a simple, low-cost, automated way to invest.
Okay, that makes sense. What about the third option? Working with a financial professional. When does that make the most sense?
Working with a financial professional can be a good choice if you need more personalized guidance or have more complex financial needs, like, estate planning or tax optimization.
Yeah.
There are different types of financial professionals: investment advisors, wealth managers, financial planners, even family offices for those with ultra-high net worth.
Okay. What are the advantages of going that route?
Well, the main advantage is having an expert in your corner to create a tailored plan, make your investments tax efficient, and provide ongoing support.
Sounds great. Are there any downsides?
Well, the biggest one is cost. Financial professionals charge fees for their services. It's crucial to understand their fee structure upfront and make sure it fits your budget.
That makes sense. But how do you even find a trustworthy financial professional?
That's a great question, and it's something the book gets into. One key thing is to look for someone who's a fiduciary. That means they're legally required to act in your best interest.
Okay, so how do you know if someone is a fiduciary?
You can just ask them. It's also a good idea to do your homework, check their credentials, track record. The book even provides a list of red flag questions to ask potential advisors to make sure they're the right fit.
Super helpful. So we've discussed these three main approaches: DIY, robo-advisors, financial professionals.
Right.
But with all these choices, it's easy to get lost in the details and lose sight of the big picture.
That's why it's so important to remember this fundamental principle: staying the course.
Okay.
That's what underlies all successful investing.
The author tells this amazing story about how the Google founders tried to sell their company for like $1 million and got rejected.
I remember that.
It's crazy. It just goes to show that even incredibly smart people can make bad investment decisions.
Exactly. It highlights that success in investing isn't about perfectly timing the market or picking winning stocks. It's about being disciplined, not letting your emotions control your decisions, and letting the power of compounding work its magic over time.
The author seems really fascinated by that combination of being hands-off but still seeing exponential growth. It's like planting a seed and watching it grow into a giant tree without having to constantly fuss over it.
I love that analogy. It really captures the essence of long-term investing.
Right. And it ties into this idea of finding joy in the journey. Investing isn't just about piling up money. It's about achieving financial freedom, security, and the ability to live life on your own terms.
I couldn't agree more.
I love that. It's so much more than just numbers and spreadsheets.
Absolutely. And that's what's so empowering about this book's message. It reminds us that you don't need to be a financial wizard or stock market guru to reach your goals.
I love that too. So let's talk about some of those good habits for investing. The book really emphasizes turning off the TV, silencing those pesky news notifications.
Right.
It's almost like they're saying ignorance is bliss when it comes to daily market noise.
Well, it's not about being ignorant.
Right.
It's about protecting yourself from information overload.
Right.
And that emotional roller coaster that comes with it.
Yeah.
The media thrives on sensationalism.
For sure.
And often presents a very distorted view of what's actually happening in the market.
It's like that saying, if it bleeds, it leads.
Exactly.
Bad news always grabs our attention more than good news.
And that negativity can really mess with our minds, especially when it comes to our investments.
Right.
We start second-guessing ourselves, making impulsive decisions, and potentially missing out on long-term gains.
So what's the solution to all this media-induced anxiety? How do we stay calm and rational when the market seems like it's freaking out?
The book argues that the best approach is to view market corrections, those dips and drops that make our stomachs churn,
Right.
as opportunities, not disasters.
Okay, break that down for me. How can a market crash be a good thing?
Think of it like a thunderstorm. It might seem scary at first, but it's a natural, necessary part of the ecosystem.
Right.
It clears the air, renews the soil, makes way for new growth.
So you're saying a market correction can actually be healthy in the long run?
Exactly. It can weed out weaker companies, create buying opportunities for value investors, and bring those valuations back down to earth.
I remember the author sharing their experience during a market downturn when their company was transitioning to a nonprofit.
Mm-hmm.
They decided to withdraw their retirement plan money and manage it themselves.
Right.
Even though it meant going against the crowd.
It's a great example of how a solid understanding of investing principles can give you the confidence to make your own choices, even when things are uncertain.
But I think a lot of people are still terrified of losing money, especially during a crash. It's tough to stay rational when you see your portfolio shrinking, even if it's temporary.
Totally understandable. But the book reminds us that the damage from market falls is usually short-lived.
Okay.
Historically, the market tends to bounce back pretty quickly after a correction.
So like that saying, what goes down must come up.
Exactly. The book cites data showing that the market often performs quite well in the months and years following a correction.
Okay, but let's be real. Watching your investments lose value, even temporarily, can be really painful. It can feel like you're being punished for doing something wrong.
I think that's a common feeling, but the book reframes this perception beautifully. Market corrections aren't punishments, they're rights of entry. Like paying a toll to access a scenic highway.
I love that analogy.
You might grumble about the cost, but it's worth it to reach that destination.
It makes the whole idea of market volatility a lot less intimidating.
It reminds us that accepting the possibility of short-term losses is part of the deal if you want long-term growth.
Right.
As Morgan Housel, the financial author, puts it, market returns are never free and never will be.
That's a powerful statement. It really challenges that get-rich-quick mentality.
It emphasizes the importance of patience, discipline, and a long-term perspective.
One thing that really struck me was the author's emphasis on index funds and ETFs.
Yeah.
They seem to be big fans of that passive investing approach.
For good reason. Index funds and ETFs are investment vehicles that track a specific market index, like the S&P 500.
Okay.
By investing in an index fund, you're essentially buying a tiny piece of all the companies in that index.
So it's like a one-stop shop for diversification.
Exactly. And because index funds are passively managed, meaning they just follow the index, they have much lower fees than actively managed funds.
Makes sense. But are there any downsides to this approach?
Some people argue that they're risky because their value fluctuates with the market. But what they forget to mention is that any investment that includes stocks will have some volatility. It's just part of the game.
And that's where the importance of a balanced portfolio comes in.
Absolutely.
Right, having that mix of stocks and bonds.
Exactly. Remember the dog and owner analogy?
Oh, yeah. The dog, the market, might be running wild, but the owner, the overall economy, is still heading in the right direction.
Right. That long-term perspective is key.
Okay, so we've covered why index funds can be a great option. But how do you actually choose the right ones? There are so many out there.
It's true, but you don't need to be an expert to pick good index funds.
Okay.
The book recommends focusing on low-cost, broadly diversified funds that track major market indices.
Can you give us some specific examples?
Sure. The Vanguard Total World Stock Index Fund ETF, VT, that we mentioned earlier, is great for global stock exposure. For a U.S.-focused ETF, the Vanguard S&P 500 ETF, VOO, is solid. And for bonds, the Vanguard Total Bond Market Index Fund ETF, BND, offers broad exposure to the U.S. bond market.
So these are all funds we can easily find and invest in through a discount brokerage account.
Exactly. And many robo-advisor platforms use these types of funds to create diversified portfolios.
Okay, so now we've got the basics of index funds and ETFs down. But let's talk about some of those psychological traps that can sabotage our investment success. The author points out that even though investing is relatively simple in theory, it can be surprisingly difficult to put into practice.
That's because our emotions often get in the way.
Yeah, for sure.
We get greedy when the market's going up.
Right.
Fearful when it's going down, impatient when we don't see results right away.
It's like we're constantly battling our own instincts.
That's a great way to put it. The book offers tons of insights into these psychological pitfalls and gives practical strategies to overcome them.
Okay, so what are some common traps we should be watching out for?
One of the biggest is what the author calls the siren song of high returns.
Oh, yeah.
You know, we're bombarded with stories of people getting rich quick.
Right.
And it's easy to be tempted to chase those big profits.
I remember the author sharing a story about a friend who got hooked on penny stocks and speculative investments, even though they knew the benefits of long-term investing in index funds.
Right.
It's like that saying, a bird in the hand is worth two in the bush.
Perfect analogy. We often overestimate our ability to pick winners and underestimate the power of consistent, disciplined investing. This can lead us down a path of speculation and impulsive decisions that end up hurting our long-term well-being.
So how do we resist those tempting sirens and stay focused on our long-term goals? The book mentions learning from our mistakes. The author had to learn some of these lessons the hard way.
That's what makes their advice so valuable. They've been there, they have the scars to prove it. They talk about developing a clean slate mentality, not letting past mistakes hold us back.
I love that idea of a clean slate.
Yeah.
It's like giving ourselves permission to start fresh and approach investing with a clear mind.
Exactly. It's also about understanding that mistakes are inevitable. Even the greatest investors have made their share of blunders.
Right.
The key is to learn from those mistakes and not repeat them.
So, like the saying, fall 7 times, stand up 8.
That's the spirit. And the book encourages us to create space between what happens to us and how we react to it.
That's such a valuable skill, not just in investing, but in life.
Absolutely. Especially in the world of investing, where emotions run high and can cloud our judgment. That ability to pause, reflect, make rational decisions, that's essential.
Okay, so we've talked about the allure of high returns, learning from our mistakes. What other psychological traps can we fall into?
Another common one is what the book calls the art of opacity.
Okay.
It's about how financial institutions often use confusing language and hidden fees to make it hard to understand what things really cost.
Like they're speaking a different language.
It can definitely feel that way. The book encourages us to be more savvy consumers of financial products and services.
Okay.
Ask questions.
Right.
Read the fine print and understand exactly what you're paying for.
The author shares some crazy stories about their own experiences with financial institutions, being steered towards products with high fees and hidden costs, even though there were better options available.
And that's why it's so important to be an informed and empowered investor.
Yeah.
Don't be afraid to challenge the status quo. Seek out alternatives that align with your interests.
Absolutely. The book also explores the 4% rule,
Yeah.
which basically says you can safely withdraw 4% of your portfolio each year in retirement without running out of money.
Sounds pretty good.
Yeah.
It does, and it really highlights the power of long-term investing and compound interest. But it's important to remember that the 4% rule is just a guideline, and it's based on certain assumptions about market returns and inflation.
So it's not a guarantee.
No investment strategy is foolproof.
Right.
But the 4% rule provides a useful framework for thinking about retirement planning and how much you can realistically withdraw each year.
Okay, that's helpful.
Yeah.
But what about protecting ourselves from, like, shady financial advisors or institutions? The author tells a story about a manager who literally disappeared to the seashells with his client's money.
That's a nightmare scenario.
Yeah.
It really emphasizes the need for due diligence,
Right.
working with reputable institutions and individuals.
Okay.
The book highlights the value of custodians.
What are custodians?
They're basically third-party entities that hold your assets.
Okay.
They act as a safeguard against fraud.
Gotcha. So like a trusted intermediary to protect your investment.
Exactly. And it's standard practice in the industry.
Okay, so we've talked about psychological traps, due diligence, custodians, but ultimately, it all comes down to taking action, right?
Absolutely. As Amelia Earhart famously said, the hardest thing is the decision to act. The rest is just tenacity.
The author really stresses that we shouldn't wait for the perfect moment or try to time the market. Just start investing today, even if it's a small amount.
I think that's such a powerful message. It's easy to get stuck overthinking and waiting for the right time, but the reality is that the best time to start is now.
They also make a really interesting point about how the stock market often starts to rally before the good news even arrives.
Yeah.
It's like it has a sixth sense or something.
It's fascinating, right? And it just shows why trying to time the market is so pointless.
The book mentions this study by Fidelity that found that their best performing clients were the ones who had totally forgotten they even had an account.
It's a testament to long-term investing and staying the course.
I love how the book uses the analogy of climbing a mountain to illustrate the challenges and rewards of investing. There will be ups and downs, moments of doubt and exhaustion, but that view from the summit is worth it.
It's such a powerful image. And it reminds us that investing is a journey, not a destination.
Right. The author shares their personal journey, and they talk about how they've come to appreciate that combination of being hands-off but still seeing exponential growth.
It's about achieving financial freedom, security, the ability to live life on your own terms.
Okay, so we've covered a ton of ground today. The psychology of investing, diversification, the power of index funds and ETFs, the art of staying the course. One of the most important takeaways is that anyone can be a successful investor.
That's right.
It's not about being a math genius or having insider information.
Yeah,
It's about having the right knowledge, the right mindset, and the discipline to stick to your plan.
I couldn't agree more. And I think the book does such a great job of demystifying the world of investing and empowering people to take control of their financial futures.
So what does this all mean for you, our listener? Where do you go from here? The book doesn't give a step-by-step roadmap, and I think that's intentional.
Yeah, I think so too.
Right,
Because your investment journey is unique to you.
right.
It's about defining your own goals, assessing your risk tolerance, and choosing the approach that best fits your circumstances and personality.
Remember, investing isn't just about numbers and spreadsheets. It's about taking control of your future and creating the life you want to live.
And as you embark on this exciting adventure, keep in mind the words of the Roman philosopher Seneca, every new beginning comes from some other beginning's end.
Ooh, I like that.
Embrace the challenges, learn from your experiences, and never stop growing.
Powerful words. And speaking of new beginnings, let's dive deeper into one of the most crucial aspects of successful investing: understanding and embracing market volatility. Now, it might sound counterintuitive, but the author makes a really compelling case for actually celebrating market corrections.
Exactly. It's all about shifting our perspective. Instead of viewing market downturns as something to be feared, we can choose to see them as opportunities for growth. Instead of viewing market downturns as something to be feared, we can choose to see them as opportunities for growth.
Okay, I'm intrigued. But how can we learn to celebrate those dips and drops when our instinct is to, like, run for the hills?
Well, it starts with understanding that market fluctuations are just a natural part of the economic cycle.
Okay.
It's like the weather, the market has its seasons. There will be periods of sunshine and growth, and there will be times of storms and corrections. It's all part of the process.
The author uses this great analogy in the book, comparing market corrections to forest fires.
Oh, yeah.
At first, a forest fire seems devastating,
Right.
but it actually plays a crucial role in the health of the ecosystem.
Exactly.
Right? It clears out the deadwood, makes way for new growth, allows the forest to regenerate.
And the same principle applies to the stock market. Market corrections can help weed out those weaker companies, bring valuations back to a more realistic level, and even create buying opportunities for savvy investors.
So instead of panicking when the market takes a tumble, we should see it as a chance to buy things at a discount.
Exactly.
Yeah.
Think of it like a sale at your favorite store. You're not going to run away screaming when you see those red clearance tags, are you?
No.
You're going to stock up on those bargains.
That's a great analogy.
Right.
But even with that positive perspective, it's still tough to watch your portfolio value go down, even if it's temporary.
Yeah, I get that.
It can feel like you're being punished for doing something wrong.
I understand that feeling completely. But the book, it challenges us to reframe that perception. It says market corrections aren't punishments, they're rights of entry, like paying a toll to access a beautiful scenic route.
Okay.
Sure, you might grumble about the cost,
Right.
but you know it's worth it to get to that amazing destination.
Okay. I'm starting to see market volatility in a whole new light now.
Good.
But how do we practically navigate these turbulent periods without getting swept away by all the emotions?
Well, one of the best strategies is to simply stay the course. Remember, the market has always recovered from downturns in the past, and there's no reason to think it won't do so again in the future. Trying to time the market, hopping in and out based on those short-term fluctuations, that's a recipe for stress and underperformance.
The author actually shares this anecdote about how they completely tuned out all financial news during a really volatile period. They just went about their life, focused on their work, their hobbies.
Yeah.
And when they checked back in on their portfolio months later, it had actually grown significantly.
It's a powerful illustration of how resisting that urge to constantly check and tinker can actually lead to better results.
Right.
Patience and discipline are key in investing.
Okay. I'm definitely feeling more zen about market volatility now. But how can we cultivate that sense of calm and detachment in the face of all the noise and fear-mongering out there?
Well, the book offers several practical tips. One of the most important is to create a clear investment plan and stick to it,
Well,
no matter what the market's doing.
okay.
This plan should outline your goals, your risk tolerance, your asset allocation, your investment strategy, all of that.
So it's like having a roadmap to guide us through the ups and downs of the market.
Exactly. Having a well-defined plan can help you make rational decisions that are based on your long-term objectives, rather than reacting emotionally to those short-term market swings.
And the book also emphasizes seeking out knowledge, really understanding those investment principles.
Absolutely. The more we understand about how markets work, the less likely we are to be swayed by fear or greed.
Right.
The author encourages us to read books, listen to podcasts, attend webinars, really seek out those reliable sources of information.
And the author also reminds us that we don't have to be financial experts to invest successfully.
Right.
There are simple, low-cost options, like those index funds and ETFs, that can help us achieve our goals.
That's right. And the book really goes into detail about the benefits of passive investing and why it's often the most effective way to build wealth over the long term.
Okay, so we've covered market volatility, the importance of having a plan, seeking out knowledge, embracing that simplicity of passive investing. But there's another part of successful investing that the author explores: the psychology of decision-making.
You got it. Even with the best intentions and a solid plan, we can still sabotage ourselves with our own thoughts and behaviors.
Right.
The book dives deep into those psychological traps that can really derail our success and offers some practical strategies for how to overcome them.
Let's talk about some of those traps. The one that really stood out to me was anchoring bias.
Anchoring bias. That's a classic.
Yeah.
It's that tendency to get fixated on one specific piece of information,
Okay.
even if it's irrelevant or misleading.
The author uses the example of buying a used car. The seller might give you this ridiculously high price to start, which becomes an anchor in your mind. And then any later offer, even if it's still overpriced, seems like a good deal.
Exactly. And the same thing can happen with investing. We might get anchored to the price we paid for a stock, or that peak value of our portfolio, making it really hard to make rational decisions when the market changes.
So how do we avoid falling into that trap?
The key is to be aware of that bias
Okay.
and to actively look for objective information. Don't be afraid to challenge your own assumptions
Right.
and consider different perspectives.
Another trap the book mentions is loss aversion. The idea that we feel the pain of a loss way more intensely than the pleasure of a gain.
Right. Loss aversion can lead us to do some pretty irrational things, like holding on to those losing investments for way too long, just hoping to get our money back, even when it's probably not going to happen.
So how do we overcome loss aversion?
Well, one helpful strategy is to focus on the long-term potential of our investments rather than those short-term ups and downs.
Yeah.
Remember, the market is volatile by nature, and those short-term losses are inevitable. It's important to keep your eyes on the prize and ride out those bumps in the road.
Another trap that I found really interesting was herd mentality.
Oh, yeah.
That idea that we tend to follow the crowd,
Right.
even if it goes against our better judgment.
Herd mentality can be super dangerous when it comes to investing.
Okay.
When we see everyone piling into a certain asset or strategy, it's really easy to get caught up in the excitement and make impulsive choices.
The author tells a story about a friend who got sucked into this speculative bubble, investing in a hot new tech stock that everyone was raving about.
Yeah.
And of course, the bubble burst.
Yeah.
And the friend lost a ton of money.
It's a classic example of how following the crowd can lead to disaster.
Right.
Key is to be an independent thinker.
Right.
And make those decisions based on your own research and assessment, not on what everyone else is doing.
So how do we resist that urge to follow the herd and actually develop our own independent investment philosophy?
Well, it starts with having a healthy skepticism.
Okay.
And a willingness to question conventional wisdom. Don't be afraid to go against the grain and do your own research. Remember, what works for someone else might not work for you.
And the author also emphasizes seeking out different perspectives, not just relying on one source of information.
Absolutely. It's so important to read widely, listen to different viewpoints, and challenge your own assumptions. The more informed we are, the better decisions we can make.
Okay. So we've talked about anchoring bias, loss aversion, and herd mentality. Any other psychological traps to watch out for?
One more that's super relevant is overconfidence bias.
Oh, yeah?
That's the tendency to overestimate our own abilities and knowledge.
I think we're all guilty of that sometimes.
It's human nature.
Yeah.
But overconfidence can be really dangerous in investing. It can lead us to take bigger risks, underestimate the chances of losing, and ignore warning signs.
The author tells this story about their own experience with overconfidence bias early in their investing journey, making all these impulsive trades based on gut feelings and not enough research.
Oh, yeah.
Which led to some pretty significant losses.
It's a good reminder that humility is essential when it comes to investing. It's important to recognize our limitations, seek out expert advice when needed, and not make decisions solely based on our intuition.
So how do we cultivate that humility and avoid falling into that overconfidence trap?
Well, one helpful strategy is to track your investment performance
Okay.
and really honestly analyze your successes and failures.
Right.
By objectively evaluating our decisions, we can learn from our mistakes and make better choices going forward.
The book also highlights surrounding yourself with people you trust, like advisors and mentors who can give you some objective guidance.
That's right. Having that team of experienced professionals like financial advisors, accountants, attorneys, they can help us avoid those costly mistakes and navigate all the complexities.
Okay, so we've covered a ton of ground today on the psychology of investing. But I want to go back to a concept you mentioned earlier, that 4% rule.
Yeah.
It sounds pretty straightforward, but I think it's worth exploring a bit more.
Absolutely. The 4% rule is a guideline for how much you can safely withdraw from your portfolio each year in retirement without running out of money.
Okay.
It's based on historical market data and assumes you have a balanced portfolio and a pretty long retirement ahead of you.
So like if I have $1 million saved, I could take out $40,000 every year.
That's the basic idea, but it's super important to remember that it's just a guideline, not a guarantee.
Right. What are some things that could affect how accurate that 4% rule is?
Well, a few things. Market returns, for one. The rule assumes a certain level of average annual return. If the market doesn't perform as well, you might need to adjust how much you're taking out.
Right.
Inflation is another big one.
Uh-huh.
It erodes the purchasing power of your money over time. The rule considers inflation, but if it's higher than expected, you might need to withdraw more to keep up with the rising costs.
Okay, that makes sense.
And then there's longevity. The rule assumes a retirement of about 30 years. If you live longer, you might need to be more conservative with your withdrawals. And of course, there are always those unexpected expenses that can pop up, medical bills, home repairs, you name it. Life throws curveballs sometimes.
So it's a helpful starting point.
Yes.
But we need to be flexible and reassess things based on our own situation.
Exactly. And the book really encourages talking to a qualified financial advisor to get a personalized plan that factors in all those things.
Speaking of financial advisors, the author shares some pretty scary stories about, shady advisors who've taken advantage of clients. It's a little unsettling.
Definitely. And the book gives some good advice on how to find a trustworthy advisor and what red flags to watch out for.
Okay, let's talk about those red flags. What are some things we should be wary of?
Well, if an advisor is using high-pressure sales tactics, like pushing you to decide quickly or invest in something you don't fully understand, that's a big red flag.
Yeah.
Also, be wary of unrealistic promises. No one can guarantee those high returns or make you rich overnight. There's no free lunch. Lack of transparency is another warning sign. If they're evasive about their fees, their strategy, their qualifications,
Right.
that's not a good sign.
Okay.
And be cautious of any conflicts of interest, like if they're getting a kickback for selling you certain products, even if they're not the best for you.
So basically, do our homework, ask tough questions, and trust our gut.
Exactly. The book has a helpful checklist of questions to ask potential advisors so you can make an informed decision.
Okay, we've covered a lot in this deep dive. Market volatility, those psychological traps, finding an advisor.
They have.
It's clear that successful investing requires knowledge and the right mindset.
Yeah.
But ultimately, it comes down to action, right?
Absolutely. As Lao Tzu said, a journey of 1,000 miles begins with a single step.
And the author really pushes the idea that you shouldn't wait, just start investing today, even if it's a small amount.
The earlier you start, the better.
They emphasize that compounding works best over time.
Right. And it's never too late to start. Even if you're beginning a little later in life, the most important thing is to take that first step and develop those good habits.
They also make a point about how the stock market often starts rallying before the good news even arrives.
Yeah.
It's like it can predict the future.
It's amazing, right? It really reinforces that trying to time the market is just a waste of energy.
Okay, so as we wrap up this deep dive, let's talk about the emotional side of investing. The author emphasizes that it shouldn't be this huge source of stress and anxiety.
I agree.
It should be a path to a more fulfilling life.
I think that's a beautiful way to look at it.
Yeah.
We often get so caught up in the technical stuff and all the fear that surrounds investing.
Right.
We forget the big picture.
Yeah.
Investing is about creating a future where we have more choices, more freedom, and more peace of mind.
The author even encourages us to find joy in the process.
Yeah, absolutely.
It's not just about the end goal, but about enjoying the journey along the way.
Exactly. Celebrating those small wins, learning from the setbacks, and knowing that you're in control of your financial future.
So as we move into the final part of our deep dive, let's explore some of the key takeaways from Zero to Millionaire and how we can actually apply these ideas to our own lives. So as we move into the final part of our deep dive, let's explore some of the key takeaways from Zero to Millionaire and how we can actually apply these ideas to our own lives.
Sounds good.
You know, as we wrap up this deep dive, it strikes me that so much of successful investing is about mindset.
Yeah.
It's not just about understanding the mechanics of stocks and bonds, but about cultivating the right mental habits to avoid those common pitfalls we talked about.
Absolutely. The author talks about developing this investor zen,
Right.
which is all about finding that balance between taking action, but also having some emotional detachment.
There's that great story in the book about how the author just completely tuned out financial news during a really volatile time. They just went about their life, focused on work and hobbies, and then checked their portfolio months later. And it had actually grown significantly.
It really shows how resisting that constant urge to check and tinker can lead to better results. Patience and discipline are key.
It also highlights the importance of having a clear investment plan and sticking to it, even when things get a bit rocky. We shouldn't let fear or greed drive our decisions.
And that's where having a trusted advisor or a well-defined strategy can be so helpful. It's like
Right.
having a guardrail to prevent you from veering off course when the market throws a curveball.
The book also touches on this idea of finding joy in the journey.
Yeah.
It's not just about reaching that final destination of financial independence,
Right.
but about enjoying the learning process and growing along the way.
Absolutely.
Celebrating those small wins, learning from those inevitable mistakes, and feeling that satisfaction of knowing you're in control of your financial future. So as we wrap up, let me ask you a final thought-provoking question. If you could give one piece of advice to someone just starting their investment journey, what would it be?
That's a good one.
Yeah.
I would tell them to focus on building those good habits right from the start. Set realistic goals, create a consistent investment plan, and really try to tune out all the noise that can distract you from your long-term objectives.
Those are excellent points. And I think they capture the essence of the book, From Zero to Millionaire.
I agree.
It's a reminder that investing doesn't have to be super complicated or scary.
It really doesn't.
It's about making smart choices, being disciplined, and letting time do its thing.
So to sum up our deep dive, here are a few key takeaways. Embrace the power of compounding, start early, and let time work for you. Develop that clean slate mentality. Learn from mistakes, but don't dwell on them. Cultivate that investor zen. Find the balance between action and detachment. Tune out the noise. Focus on your long-term goals. And lastly, find joy in the journey. Celebrate your wins and enjoy taking control of your financial future.
And remember, this deep dive has only scratched the surface of what's in the book. So we encourage you to check out From Zero to Millionaire for a deeper dive into these concepts. We've also included links to some helpful resources in the show notes, articles, websites, even a list of questions to ask potential advisors.
And feel free to reach out to us with any questions or comments. We're always here to help.
Thanks for joining us on this deep dive into the world of investing. Until next time, happy investing.